We've been asked a lot lately, should we be doing something different with our investment strategy? Maybe you've had the same question in light of the choppy markets we've seen this year. In fact, when thinking about your investment journey, do you have a set of rules and investment principles you rely on when deciding how aggressive or conservative to be with your investments and when to change that? To help you answer that question, in today's episode, we're going over our 10 investment principles with the hopes that it could help you compare to or use them to create your investment blueprint. I'm Chad Smith here with Mike Eklund this week. And before we jump into the show, we're getting still a lot of interest in our ebook, Your Game Plan for Market Volatility. And in this guide, we include 7 things you can do to prepare your portfolio in a bear market, how not to worry about a falling stock market, and reminders to give you confidence when headlines continue to get worse. If you'd like to grab a free copy of this guide, we've included a link in the show notes for this episode in the podcast app you're listening to make it easy for you to download. Just look for the link that says download the ebook, Your Game Plan for Market Volatility. Now, in today's episode, I've recently been listening, I was telling Mike before the show here a lot, to the Founders podcast of late. It's basically a show that breaks down autobiographies of great entrepreneurs or top performers in history. Each episode, they take an autobiography. I think he's 260 some episodes or autobiographies in so far. And one of the latest episodes I listened to was actually on Kobe Bryant. And his smaller biography called The Mamba Mentality, it caught my attention as we were preparing for the show because at one point late in his career, Kobe began to notice others' practice habits, and he basically wrote, if you know the basics of the game at this point, it's to the point where you have an advantage over the majority of players. It's that idea that the importance of fundamentals and mastering the basics of the game to separate yourself, it can create separation from others. So today, we're going to walk through our 10 investing principles, the basics that drive and guide our investment decisions when creating portfolios for clients. I think it's informative, and it can be good to go back to those basics because I like this quote from David Booth, one of the founders of Dimensional Fund Advisors. Few things are more important than developing a well thought out plan when investing your life savings. It can be easy to agree with investing principles, but hard to stick to when times get tough. I think that's where we are today. So we want to dive into this and see, kind of dig behind behind this idea, because it could be applicable to you and useful to you when you're creating your investment strategy. So Mike, we've got these 10 we're going to walk through. Let's jump into the first one there. You want to take it?
No, thanks, Chad. And the first principle, as we've discussed, is, really what your goals are. What is the money for? It sounds simple, but, for those of folks who have worked with financial symmetry before, that we start with a plan first. We create a financial plan, and then we create the portfolio. Because the money needed for a down payment on a house in a couple of years, or for the kids' college in 5 years, is a lot different than the money maybe needed in 30 years for retirement. And so we always start with the plan first, and then based on your goals, your desires, we then develop and implement a portfolio. So it sounds simple. You're like, yeah, Mike, I know that. It sounds pretty simple, but most people don't. Most people are looking for the hot stock or the hot tip, or here's where can you make quick money? But you really got to start with what the money's for, and then we can develop a plan from there. Portfolio from there.
Yeah, it can give you the confidence in understanding why you are still investing and when you may need that money. And we're going to jump into that with some of these other principles too. But that's what really starts this conversation of understanding your desired outcome, right? What is that desired outcome? So and then we jump into number 2.
Yeah, this one is, I think it's overlooked a bit. I think it's just a general view of stocks or ownership of businesses. Versus if you have money in the bank account, or if you own bonds, you're lending to someone. So it's owning something versus lending to someone. And over history, and I know this because I'm now reading, Stocks for the Long Run, version 6, which recently came out, which is a good kind of background, talk about the basics. It was first published in 1994. If you look back almost over 200 years, stocks have returned almost a little over 10% a year, and which is almost double of what bonds have done over that time period. I know it's a long time period, but even during shorter time periods, you see similar results. And I think it's because as owner of businesses, you take on more risk than lending to a business. But I think individuals don't focus on much of how much of their portfolio is split between the two. And I think that makes a big difference on their long-term results. I just looked at, just quick math. If someone is saving about $12,000 a year for the next 40 years, the difference between that 10% and 6% is over $3.5 million. So just a simple, and it's assuming you're doing that every year thereafter, but it doesn't take rocket science. But the more investments you invest in companies, I like to call it companies versus stocks, historically, the better your long-term results are.
Yes, and many times these decisions are made maybe on the outset. For example, in 401ks for people when they're setting up their open enrollment, right? They may pick an investment. It may be a target date fund. You don't always understand what the breakdown of stocks versus bonds is in those funds. And it could be grossly off from what you need it to be to accomplish the goals that you're looking for. So that's where it comes back to that plan to start with, understanding when you're going to need the money and how well you can sleep at night with the volatility that's happening. We're going to run through that here in a second as well. But then getting you to that point where you can be better prepared in the long run and understand what you're actually investing in inside of those elements inside of your 401k, mutual funds, and exchange traded funds. That leads us into our next one here, Mike, and this is one that gets a lot of attention because this is where we feel like we can start tinkering with things, right?
Yeah, this is probably the most fun part of our job. I don't want to say fun, but the interesting part of our job is investor behavior. And when things are going well, it's common for people to think that they are a rock star investor. They know everything what they're doing. This is easy. Why do I need to work with an advisor? Why am I paying anyone? And then when things go south, they're kind of saying, well, maybe I'm not as good as I think I should do. Or, you know what, maybe I need to go in there and make a couple changes. I need to kind of make a couple tweaks to the portfolio. What we have seen is the more adjustments you make based on market conditions, either through the market fad or fear, the worse your long-term results. So typically what happens is people will sell something or buy something that's been the hot performer or the poor performer when they should be doing the opposite. I can think back to 1999. Everyone loved tech stocks. 2005, everyone wanted to buy real estate and condos in Florida. Last year, everyone wanted to buy GameStop or AMC, the meme stocks. So it's avoiding those fads and fears. And the reality, I've said this before, I'll say it again, investing should be boring, or most people want to make it exciting.
Yeah, I love another great quote here from a fellow advisor. One of the ways to avoid feelings of uncertainty and discomfort is through action, but action that is not adequately considered, ironically, leads to more uncertainty and discomfort. Action works better when it is part of a plan integrated with your values. I think I've said plan in each of the last three. I'll probably say it in every one of these because without the blueprint to start with, it's very difficult to put together an investment strategy that's going to help you meet your goals because you're likely going to be investing in things that are influenced by current events. And that's why this investor behavior is so difficult to maintain and stay consistent with and disciplined in the times when the tides get rough. So when those tides get rough, we generally move to this action item, right? Number 4, that'd be market timing.
Yeah, I mean, don't you have a crystal ball, Chad? Isn't that? Don't you know when to buy and when to sell? Isn't that what we're getting paid for?
I know when that feeling creeps up of making it feel like you can do something, right? I know when that feeling's there.
The challenge is you have to be right twice with market timing. I mean, a lot of folks will say, I've heard individuals that felt like they knew the COVID decline was coming and they sold stocks, but then they didn't know when to buy back, and the market rebounded really fast. Those same individuals now are looking at and saying, with all the news overseas, with inflation in the U.S., we have a presidential election coming up. It's probably a good time to take a break and try to, take some chips off the table. But the reality is, you just don't know. I mean, the market can turn faster than you can realize. And the only thing I know is that we've had, I think, about 17 bear markets. I want to say the last 100 years or so. And the only thing consistent about all of them is they've all been temporary. So that's the one thing to keep in mind is that, these declines, they will end and they'll move forward to new bull markets. When that timing occurs, we don't know. But to realize the full return of owning businesses or stocks, you have to stay invested over the long term.
Yes, and we have countless additional articles, podcasts, and YouTube videos on this topic. We've done a lot of episodes. So if you just want to search our blog, if you want to read more about this, we've written and tried to approach it from all kinds of different angles, and you might find it interesting. You may want to challenge it a little bit. We'd love to hear from you on that as well, because it's a philosophy that continues to get challenged each time we move into a decline, because it's in our nature and our instincts are super strong to point us in the direction to think that we can do something about this. A couple quotes there that I enjoy. One from another fellow advisor, Nick Majuli. Being right about something and making money off of it are two different things, right? Because like you mentioned, Mike, you can be right, the first time and it feels good, but the second time is more difficult. The third time's even more difficult. The second one is the stress of being out of the market can be just as great as the stress of being in the market. I love that one as well. And we've said that for years now and try to remind ourselves of that when we're making recommendations and having conversations with clients. Okay, so moving into this fifth one here is just in general, market declines and our philosophy behind that.
I get excited, and this is kind of a weird way to say it, is market declines create opportunities. And now most people will think the opposite. I think all the research shows that believe people view a loss about 2 times as painful as a gain. So obviously, to see your statement and the balances, although historically temporary, go down is very challenging and difficult to look at. I would say those give opportunities to buy at lower prices, which is great, especially if you're younger and you're saving. And even if you're retired, you may have a portfolio set up to buy when things go down as well. But this is normal. I mean, historically, we have seen the market decline somewhere in the neighborhood of 15 to 16% a year. And then every about 5 or 6 years, we get what's called a bear market. That's the market goes down 20% or more. On average, it's about a 30% decline. So market declines are the fee we pay for higher returns. And as one of our principles, we know what's going to happen. We know what's going to happen. It's going on now. It's going to happen in the future. And, the best thing you can do is stick to your plan, as Chad likes to say, the plan, because the worst thing you could do is try to make changes, as we said, number 3, to try to react and change your plan due to current, market fads or fears.
Well, it can be a fun and normal thing to react to news, right? When you're watching it with family, friends. These media narratives, they're stories. They're strong stories that are put together to elicit an emotion from you, right? To keep watching. Many times it's fear-based because that's a strong pull for us to keep watching. But they are interested in eyeballs. Media, that's the goal, right? They're interested in the eyeballs and listeners, not your financial well-being. So, Mike, what is it you like to say about watching the news?
It can be expensive.
Exactly. So that brings us to our next principle here, and that this is a way to fight against some of that if you can maintain the discipline to do it. It's another big D, the diversification principle.
It's pretty straightforward in that there's always some part of the portfolio that you're not going to like, and that's how you know you're diversified. Not being diversified is owning, one stock. Let's say you own just Apple or Amazon, and that's it. Being diversified is owning a mix of companies or a combination of, companies as well as, bonds as well. It helps you with the kind of long-term smoothing out the results because there's times when not being diversified can look good. There's a reason why, Jeff Bezos and Elon Musk are so rich and because they have such a large percentage of their own stock, but there's also the risk of that stock goes to zero, and diversification helps reduce that risk. So it is always a challenge because when you're diversified, you'll always look at the thing that's done well and say, well, why don't we own more of that? And the thing that's done poorly and say, well, why do we own that? But that just knows how you're diversified, and owning a mix of global companies, U.S. and international, is the best way to reach your long-term goals.
Yeah, and I like your comment here that you always not like something in your portfolio if you're truly diversified, right? So
yeah, I mean, you think about like the 90s, everyone wanted to own tech stocks, and then the 2000s, it's like give me as much real estate as you can, rental real estate, and then the last 10 years, it's been why own any international stocks? They've stunk. So that's how you know you're diversified, when you own something in the portfolio you don't like.
Speaking about the portfolio in general, let's talk about our philosophy on your portfolio and the ideas behind how we think about that.
Exactly. Yeah. So our portfolio, our view is there's short-term needs and there's long-term needs. So short-term needs is the money you need the next, let's say 5 to 7 years for, living expenses, down payment on a house, the kids for college. That money should be more conservatively invested. When I say conservatively, I'm more high quality bonds that kind of mature around the time period when, the money is needed. Now, money not needed in the short term, for retirement, for healthcare costs in the future, we talk about inflation. We want that money to grow. So we want that money in owning, stocks or companies, because historically they've grown at about 3 times the rate of inflation. So we like to call it, we're short-term pessimist and long-term optimist. Now, I will say that phrase initially is from Morgan Housel, a very popular writer and author, but it's the way we structure our portfolios, in that even during declines like this, we have money set aside in the short term to help clients, spend their money as they need to without selling the stocks. But over the longer term, historically, the more time you have, the less risk there is investing in stocks.
Yes, one of the more powerful and reassuring conversations that we have with clients when we're talking through this in market declines is the amount of safety that we have built into their portfolio. It's that, oh yeah, moment of understanding. Okay, we've thought about this. We have planned for this beforehand to make sure that you have the money you need to sustain you through this decline. So you don't even have to worry about what, and I know that you will. We know that you will. You can't completely isolate yourself from that. But it helps you to mentally account for that idea that, hey, you have these next 5 to 7 years taken care of. So allow the portfolio to misbehave, if you want to call it that, in the short term, and then get back to normal on its long-term appreciation route. So, and that brings us to this next idea, because so much of investing is about comparison. Friends, family, what it should be doing compared to what you think it should be doing and how it's made up. So let's talk about what you should truly be comparing to in this benchmark conversation, this next principle.
Yeah. So for our eighth benchmark, it's really our eighth principle. It's what benchmark you should be using. Our view, it's the benchmark is, are you on track to reach your financial goals? Because the saying goes like, hey, let's say your benchmark, you personally, the benchmark is the S&P 500. You beat the benchmark, but you run out of money at age 80. Are you successful? Did you beat the benchmark? When the reality is, setting up a plan and having a benchmark for long-term success is more important on beating, kind of an arbitrary, index fund or et cetera. So I know it's complicated for folks because everyone wants to talk to their friends and family and say how well they're doing versus XYZ benchmark. But I think the true benchmark is whether or not you're on track to reaching your goals.
Yeah, and this is where the FOMO comes in, right? That fear of missing out is super strong because you hear these percentages being made by certain benchmarks that are measuring certain asset classes, maybe new asset classes. This was really big during the crypto boom, right? Where, you saw eye-popping returns, and it just made you salivate to think that you could be a part of that. And we all have that as a part of our DNA, and wanting to be a part of that. It takes discipline to not succumb to those desires when you're investing. And that's why investing is so difficult, and why these principles are needed to be, you need to go back to them, right, during these and remind yourself of them, Mike. I mean, how many times do we look at this document and think through this? I mean, we meet at least monthly talking through these things, but we meet weekly with our advisors and talk about these tough questions. And many times these principles are the answers to those questions. So it can be very helpful to run through that. So when we're looking at number 9 here and thinking about actual investor returns, let's talk about that principle.
Yeah, I mean, this is where I think individuals always, like I said earlier, always want to find the hot stock or fund or investment to kind of have these really high returns. But multiple studies have shown, and we've seen it directly, is a majority, or even up to some studies have shown 90% of your return is just going to be driven by a few key principles, such as we talked about earlier, how much of your portfolio is in stocks versus bonds. It sounds pretty simple, but how much do you own companies versus you lend to them? The second thing is your behavior in response to market declines or fads or fear. Were you buying Bitcoin at 60,000, or were you, buying tech stocks in 1999, and how you react to that? And then during the COVID decline or more recent results, are you selling as your portfolio goes down? So I think your response is going to make a big driver. And then the final thing is just the quality of your investment plan. How diversified are you? How much? How do you rebalance when things go well or go poorly? How tax efficient is your portfolio? So that it matters, but the first two definitely matter a little bit more. But we see a lot of people focused, not on their, they try to find the hot next best thing. Instead, don't focus on kind of the big picture of those 3 factors that are such a big driver of long-term results.
So in our 10th principle here, I love this idea because so often we'll talk about the long term, but this really kind of crystallizes what long term is in talking about what opportunity means.
Yeah, and I think if you've listened to the first 9 ones, you might say, well, what do I just do? Just buy a S&P 500 index fund and I'll never do anything again. I mean, that is one option, but our approach is we tilt your portfolio toward, it sounds kind of boring, towards investments or stocks with expected higher returns. And so part of this is what's called factors. And these are our studies have shown that cheaper companies, smaller and more profitable, do better than larger companies over the long term. But there's a reason why we have this as number 10 and not number 1. Because people always go to this first, but the reality is you have to have a plan set up. You have to have the right amount of stocks to begin with. You have to have, your behavior in the right place before you can start thinking about, okay, like how do I actually invest the money? And so for us, we're investing it in areas where we think we expect higher returns over the long term than just the kind of quote unquote benchmark.
Yes, and I like this idea of thinking in decades, not days, right? Because so often we get hung up in what is the daily return? What's the market doing today? How's it looking? Should I go ahead and make this purchase today versus yesterday or next week? Should I wait a few days? All these different ideas can move in and cloud your judgment on what is happening over your lifetime of investing. If you think about it, when you're retiring today too, because many of our episodes are designed for people that are on the cusp of retirement. I mean, you could be looking at a 30 to 40 year time horizon. And so often I'll still hear that idea, now that I'm retiring, shouldn't we be getting a little more conservative in our investment strategy? Well, that depends on your plan, because if you don't need the money, if you're going to have a high Social Security and pension payout, what are the goals for your money if you don't use it? So there's many other questions that come up in that planning approach, and it can be incredibly instructive and I think give you a lot of peace of mind in running through scenarios. And that's what we do in our planning aspect. That's how we start all of our relationships. But we wanted to put together this episode because we're talking more about this with clients, and thought it'd be interesting to hear from clients, what are your general investing principles? If you sat down and wrote out, what your investment strategy is about, what would that look like for you? And how do you refer back to that to use it as your discipline when you're making those decisions? We've got a one-pager on this on our website that you can download under our wealth management section, the general investing principles. You can go there. We'll put a link in the show notes to it as well, so you can take that and use it for what it's worth, and maybe help to craft your own investment plan, your own blueprint, if you're doing it on your own. If you're not, we're here to help. Many other financial advisors across the country as well can help out if you're looking for one closer to you. But we appreciate you listening. Certainly every 2 weeks with us. We're moving inching closer to 200. And then our YouTube channel is also growing. Appreciate you watching there. And if you wanted to see some graphics, we'll throw in some graphics there that can make it a little easier for you. The progress principle, Mike, do you have one to close here?
I mean, I think make sure you have a plan to start with. And then, if you don't feel confident you have a plan and principles in place, then it's time to work with a fiduciary advisor to help you.
Well, Mike, as always, appreciate you joining the show, carving out some time for us.
No, I enjoyed it. Thanks, Chad. It was good.
You're a busy man. You work hard on this stuff for us. So appreciate you coming back. I know the listeners do as well. We'll be back in 2 weeks. Send us any feedback and questions you like for future show topics, and we'll talk to you then. Thanks.